We've seen a lot of distress already in the Hong Kong Chinese market valuations. The H shares are cheaper. I think that's unambiguous. But if you are really playing the asymmetric risk-reward, that the downside is more limited if the downtrends continue economically. But if we see a positive surprise, we could see dramatic upside, and that would be, I think, more significant in the H shares market. So a preference for H shares does make a lot of sense, Sri, in my view.
What do we need to see in terms of the policy response to really get momentum associated with the northbound trade going?
Unfortunately, Sri, I think we need to see significantly more in the way of policy stimulus from the Chinese authorities. I think there's still significant concern about downside risk for the macro outlook for China. We've talked at length about the property market. That's still a big hole right there. But what's more worrying is that consumer confidence is very clearly weakening. And the last thing you want in China right now, when leverage levels are so high, is to fall into a deflationary spiral. And with still demand weaker than the supply side of the economy, we know that manufacturers are cutting prices, competing with one another. And I think the authorities got to be real careful to try to stamp that dynamic.